They told you that a 30-year fixed-rate mortgage was the safe way to buy the American dream. They told you that if you locked in your rate, your biggest monthly expense would never change. They lied. What they handed you wasn't a fixed payment. It was a fixed interest payment wrapped around two fully variable cost centers, property taxes and insurance, bundled into a single escrow line so the volatility stays completely invisible until the servicer mails the annual reassessment letter. By then, you've already signed. The ink dried a year ago. In the next 10 minutes, we're not going to discuss whether homeownership is emotionally meaningful. We're going to run the brutal calculus on why the American middle class is being mathematically evicted from home ownership, even after they clear the down payment, pass underwriting, and get the keys. Escrow mechanics, insurance spiral dynamics, 30-year opportunity cost, institutional capital structure advantages, maintenance cost reality. We are establishing this with arithmetic using 2026 actuals, and every number in this video is sourced. The escrow architecture. Take a standard transaction. $400,000 purchase price, 30-year fixed at 6.5%, which, as of June 2026, is precisely in line with the Freddie Mac weekly average of 6.48%, with 15% down. Your principal and interest payment is $2,528 per month. That number is fixed. It does not move for 360 consecutive payments. The bank told you that. Your realtor told you that. Your loan officer told you that. Technically, all three of them were correct about that one number. But that's not what you pay. You pay $3,136. The additional $608 is escrow. $333 for property taxes, $275 for homeowners insurance. Unlike the P&I, those two figures are recalculated every 12 months based on actual assessed value and actual insurance premiums as they exist in the market at that moment. The servicer runs the analysis internally, adjusts the escrow account, and sends you a letter informing you of your new monthly obligation. You don't negotiate it. You don't appeal a timeline. You absorb it or you go delinquent. Maryland property tax reassessments averaged 12.7% statewide for 2026. That is the official SDAT figure, covering 789,178 properties across all 23 counties. Guilford County, North Carolina posted residential parcel increases of 40 to 60%, with some neighborhoods higher than that, triggering a record 243% surge in revaluation appeals. Running a conservative 25% increase on the $333 monthly tax line moves it to $416. Insurance premiums have risen at roughly twice the rate of general inflation since 2021, a 46% cumulative national increase per Insurify's 2026 projections, pushing the $275 insurance line to $330 in year 2 using a conservative 20% assumption. Combined, that is $138 more per month in escrow. $1,656 added annually to the cost of a house whose P&I payment never changed by a single dollar. That's year 2. Now run it forward. At a sustained 10% annual escrow cost increase, which is actually below what high-growth markets are currently experiencing, the compounding works as follows. Year 1, your total monthly payment is $3,136, with $608 going to escrow. By year 2, escrow climbs to $669 and your total hits $3,197. Year 3, $736 in escrow, total $3,264. Year 4, $809 and $3,337. By year 5, you're paying $890 per month in escrow alone for a total payment of $3,418. Your so-called fixed mortgage is now costing you $282 more per month than it did at origination, $3,384 more per year for the exact same house. The P&I hasn't moved. The escrow mechanism absorbed two externally driven cost variables and passed the full volatility directly to you. No cap, no ceiling, no exit mechanism short of selling or refinancing into a new product with new closing costs attached. Whether the servicer calls it an escrow adjustment or a premium increase notification is irrelevant to what it does to your monthly payment. The insurance spiral. Between 2021 and 2024, homeowners insurance premiums increased in 95% of U.S. zip codes. That figure is from the Consumer Federation of America's April 2025 analysis using proprietary industry data across every zip code in the country. The national average increase over that period, 24%, rising at more than twice the rate of general inflation. Insurify's forward projection for 2026 puts the national average premium at approximately $3,057 per year, reflecting a 46% cumulative rise since 2021. This is not a regional story. This is not a weather story. It is an actuarial repricing event happening at national scale. And the state-level breakdowns make the national average look mild. Utah saw a 59% premium increase between 2021 and 2024, Illinois 50%, Arizona 48%, Pennsylvania 44%. These are not outlier markets failing in isolation, they are the moderate cases in a system-wide reset. Then there is Florida. The average homeowner's insurance premium for a $400,000 home in Florida in 2026 is approximately $9,283 per year, based on Insurance.com's March 2026 analysis, nearly 4 times the national average. On a 30-year hold, that single cost center totals $278,490. At 2019 premium levels of roughly $1,200 per year, the same 30-year spend would have been $36,000. The $242,490 gap between those two figures is the cost of 1 decade of actuarial repricing on one policy for one house. Not a monthly annoyance, a structural asset destruction mechanism baked into the cost basis of the investment from the day of closing. Insurers are repricing climate and litigation exposure in real time, and in many markets they are doing it faster than household incomes are growing. State Farm and Allstate have formally exited certain California and Florida markets. What remains for those homeowners are state-operated residual market plans, the insurers of last resort, at premiums running 2 to 3 times the private market rate, with higher deductibles, narrower coverage triggers, and slower claims resolution. First Street Foundation's 2026 climate risk modeling identifies 35.6 million properties, approximately 25% of all U.S. real estate by count, as facing material insurance challenges, uninsurable in the private market, experiencing premium acceleration that outpaces income growth, or already reliant on residual market coverage. 1 in 4 properties in this country. Florida's market did show early stabilization signals in 2026. Citizens Insurance filed an 8.7% rate reduction, and private carriers began re-entering select segments following legislative reforms. The structural damage to long-term cost basis, however, is already embedded in every policy written at peak crisis premiums. The $242,490 gap between what a Florida homeowner paid over 30 years in 2019 versus 2026 does not close because the market stabilizes in year 8. It is locked in at origination. The opportunity cost calculation. A household with $60,000 in savings applies it as a 15% down payment on a $400,000 home. Loan amount $340,000 at 6.5%. Principal and interest $2,150 per month. Total equity accumulated in year 1 after interest allocation to the lender, approximately $5,200. Now take that same $60,000 and place it into a broad S&P 500 index fund. The 30-year annualized return on the S&P 500 from January 1, 1996 through December 25, 2025 is 10.4% per Fidelity's published historical data, a figure that incorporates the dot-com collapse, the 2008 financial crisis, and the 2020 pandemic crash.
Compounded forward, that $60,000 grows as follows. At year 1, the investment position holds $66,000, already exceeding a full year of home equity accumulation. By year 5, the fund holds $96,931, while the homeowner has built roughly $30,400 in equity. Year 10, $155,625 in the fund, $68,000 in home equity. Year 20, $403,650 against $160,000. At year 30, the S&P position has grown to $1,046,964. Total home equity at payoff, $340,000. The raw investment gap is $706,964. That's before you add the cost side. Over those same 30 years, the homeowner paid $434,000 in mortgage interest, money that serviced debt, not equity. Approximately $240,000 in property taxes modeled at a 2% effective rate with annual increases. Roughly $91,710 in homeowners insurance at the current Insurify national average, and $264,000 in maintenance using the actual 2026 benchmark of $8,808 per year. Total cost of ownership over 30 years, approximately $1,030,000. The asset itself, assuming 1% annual real appreciation, is worth roughly $540,000 at the end of that period. Now, the counter-argument most finance professionals will reach for immediately is leverage, and it deserves more than a dismissal. A $60,000 down payment controls a $400,000 asset.
If that asset appreciates at 3% annually instead of 1%, a historically plausible rate in supply-constrained markets, the 30-year value climbs to roughly $970,000. Equity at payoff would approach $630,000, narrowing the gap with the S&P position considerably. The capital gains exclusion on a primary residence, $500,000 for married filers, means a meaningful portion of that appreciation is tax-free, in a way the S&P gains are not. These are real variables, and they can shift the math materially. The problem is that 3% real appreciation assumes a market with constrained supply, stable insurance costs, and property tax increases that track inflation rather than outpacing it, all three of which are exactly what this script has been documenting as increasingly unreliable. The leverage argument is strongest in the environment that is becoming least available to the buyers who need it most. What this model does establish is what the transaction actually costs when all cost centers are fully accounted for, which is not how this transaction is presented to buyers. The standard pitch excludes escrow volatility, uses the 1% maintenance heuristic instead of actuals, and frames equity as pure accumulation rather than net of carrying expenses. Correct for those omissions, and the arithmetic looks substantially different from the brochure. Institutional capital structure advantage. In March 2024, a 3-bedroom house in suburban Atlanta received 11 offers in 4 days. The winning bid came in at $47,000 above asking price in cash from a company that owned 12,000 other homes. The family that lost that bid was pre-approved at 6.5% and had been saving their down payment for 3 years. What they were competing against was not a wealthier family. It was a capital structure. Large-scale single-family rental operators access commercial credit at 3 to 4% or acquire with cash drawn from pooled capital structures, REITs, private equity vehicles, institutional debt funds, where the blended cost of capital sits materially below anything available through a residential mortgage product. On that same $400,000 acquisition, the retail buyer at 6.5% pays $510,000 in total interest over 30 years. The institutional buyer at 3.5% pays $286,560. The all-cash buyer pays $0. The $223,440 capital cost gap means the institutional buyer can overbid by 15 to 20% on any given property and still achieve equivalent returns. There is no income level at which the retail buyer closes that structural gap.
Then add the tax architecture, because this is where the asymmetry compounds. The institutional owner depreciates the residential asset over 27.5 years under IRS Schedule E rules, a non-cash deduction of roughly $12,000 to $14,000 per year against rental income. They execute 1031 exchanges to defer capital gains on portfolio dispositions indefinitely. Mortgage interest is deducted at the entity level without the standard deduction offset that dilutes the retail buyer's equivalent benefit. The retail primary residence generates no depreciation whatsoever, and the mortgage interest deduction is partially neutralized by the $29,200 standard deduction threshold for married filers in 2026. One data point that circulates widely needs precision before it gets misread. The U.S. government accountability figure, institutional investors controlling approximately 25% in Atlanta, refers specifically to Atlanta's single-family rental market, not the city's total housing stock. Institutional ownership of Atlanta's overall housing stock sits closer to 4.4% of all properties, per Parkle Labs data. The competitive displacement is not evenly distributed. It is concentrated in the rental market and in the entry price inventory segments, where first-time buyers compete directly against operators with sub-4% capital costs, 27.5-year depreciation schedules, and acquisition teams that close in cash.
Nationally, all investor categories combined, institutional operators and individual landlords, purchased 27% of homes sold in the first quarter of 2025. That is a narrow battlefield, and it is precisely the one the retail buyer cannot avoid. The maintenance cost reality. $8,808. That is the actual annual maintenance cost for a typical U.S. home in 2026, per Pearl Certification's annual report, a figure drawn from the U.S. Census Bureau's American Housing Survey, Bankrate's Hidden Costs of Homeownership analysis, and U.S. News and World Report survey data. The 1% rule produces $4,000 on a $400,000 home. The actual number is more than double that, and has been for several years running. The 1% heuristic appears in mortgage pre-approval workshops, financial planning software, real estate blogs, and new homeowner seminars as though it were a calibrated actuarial estimate. It isn't. It was a rough rule of thumb built for a labor and materials cost environment that stopped existing in approximately 2021. The full picture of annual carrying costs beyond the mortgage, maintenance and repairs at $8,808, utilities and energy at $4,494, property taxes at $4,316, homeowners insurance at $2,267, internet and telecom at $1,515. The total is $21,400 per year. $214,000 over a decade spent entirely on maintaining and occupying the asset without building a single dollar of equity, appreciating no asset value, compounding toward nothing. Structural repair costs increased 14.1% between 2022 and 2024. Plumbing labor and materials 23.6% over that same two-year window, per the Pearl data. The underlying drivers, skilled trade labor shortages, materials cost persistence from post-pandemic supply chain restructuring, and the deferred maintenance backlog that accumulated during the COVID-era transaction freeze when owners held rather than sold, are not resolved and show no trajectory toward resolution. The gap between the heuristic and the actual number is not closing, it is widening. The closing numbers. Mortgage interest on a $340,000 loan at 6.5% is $434,000. Property taxes over 30 years at a 2% effective rate with compounding is $240,000. Homeowners insurance at the Insurify 2026 national average of $3,057 per year is $91,710. Maintenance at Pearl Certification's 2026 documented actual of $8,808 per year is $264,240. Total carrying cost over 30 years, not including the original purchase price, is just over $1,029,000.
The renter who placed that same $60,000 into the S&P 500 at the start of that period and carried none of those cost structures ends 30 years holding $1,046,964 in liquid non-leverage assets, subject to long-term capital gains tax on the gains, which narrows the gap but does not close it. The rent versus own calculation is genuinely dependent on conditions that vary: local appreciation rates, rent trajectory, holding period, home price performance in a specific zip code, and a household's ability to maintain investment discipline across a 30-year period without liquidating during a market downturn. Anyone who hands you a universal answer to that question is not doing analysis, they're selling a conclusion. What the numbers above establish is narrower and harder to argue with. The ownership transaction costs substantially more than the mortgage payment implies. The escrow mechanism passes variable costs to the buyer with no ceiling and no recourse. The insurance market is undergoing structural repricing on a timeline that does not accommodate 30-year financial planning built on 2019 assumptions. And the institutional buyer in this market holds capital and tax advantages that the retail buyer cannot replicate through income alone. Those are the mechanics. The arithmetic is right there.